Welcome back to Your Average Investor. Today we're going to talk about how to sell covered calls to generate extra income, protect from downside, and any other reason you might want to sell a covered call. To do so, I'm going to be using thinkorswim's on-demand feature. So as you can see, these are simulated values. This is not me trading in real time, but these are accurate data as it was historically tracked in the stock market. So I've got my date set to April 5th, and I'm going to buy 100 shares of SoFi. This is the first thing you need to do in order to buy or to start selling covered calls is you need to buy the underlying asset. And because when you sell a call contract is always worth 100 shares of an underlying security, you have to buy in lots of 100. So for example, I couldn't just buy one share and sell a call on that. I have to buy 100 shares. So in this case, it's going to cost me about $731. Depending on what I got filled. There we go, virtual fill for 7.31. So you can see here now, that's my position. SoFi, 7.31. Oh my gosh, I'm down $1 already. So let's say I've bought and I'm looking at this like, I think this is a good zone to buy in because it's been basing here and then moving back up to 9 or 10. But just in case it moves down back to like 6.5, I'm going to go ahead and sell a covered call. So to do that, I'm going to move to the Trade tab if you're in thinkorswim, or on Robinhood you would click Trade Options, and I'm going to look at about 30 days out. There's different strategies you can do for doing weeklies or monthlies or leaps that are 4 or 5 or a year out, and it just depends on what your preferences are. So let's say what I want to do here is I want to sell. Let me say I'm going to sell this call 8.5. And I want to get, it's currently going for $29 on the bid, $34 on the ask. Let's see if I can get it for $31. I'm going to see if I can sell that for $31, and it filled there for $31. That's fantastic. So what's just happened is I have limited my upside, but I've also protected my downside just slightly, and I've generated $31 in income right now. The way I did that is I bought a $730 position, and then I sold this call 8.5 for $31. Well, what that means is by May 10th, if this position expires worthless, I get to keep this $31 and I get to keep my 100 shares of SoFi, unless, of course, if it doesn't expire worthless, let's say SoFi goes up to, say, $10 per share by expiration. Well, in that case, I've got two options. One, I can roll the contract by buying it back and selling another one later dated, and try to get out of the contract that way, or I can let the contract exercise and I will be forced to sell my shares at the contract price of $8.50 a share. So considering I bought at 7.31, let's just do a little bit of math here. We're going to go 8.5 minus 7.31. That's a profit of $1.19 per share. Over 100 shares is $119, plus I made $31, we'll call it $30 after transaction fees, in premium selling this contract. So I've made $149 on a $731 position. So if I divide that by 731 and then times that by 100, that's a 20.3% profit over the course of 35 days. Not bad at all. Well, let's fast forward the time a little bit and see what happens so you can see how this looks in your account over time. Remember, I've got the date set to April 5th. So let's fast forward 2 weeks to April 19th, and we're going to see what happened to SoFi. So again, I bought on April 5th, and the price was about, 7.31 when I bought, and we are now fast forwarding a couple of weeks to April 19th. And look at this, the price, if you follow this chart down here, the price when I bought was about 7.3. Looks like it came up and touched almost $8, and then it came back down, and now we're at like 7.24. So, oh my gosh, I'm down on my position by $8, but check this out. Because I sold this contract has now decreased in value by $9. So overall, I'm up on the position by about $1.50. Nothing to write home about, but it's protected me against this downside, right? I lost a little bit of money so far. If I were to exit this position, I'd be, positive $1.50. But even though SoFi has gone down, I haven't lost money yet because I sold this contract. So let's fast forward another week so you can see what happens when we push this out to April 26th. And of course, the closer that it gets to expiration, generally the less value there will be unless, like what we see happening right here, the price of the underlying security goes up. So now this is really interesting. We'll wait till this buffers and loads. You can still see it's still buffering up here. But the price just moved from about 7.2 to 7.75. So now in this case, check this out. My contract, the value of this contract now went back to 0.3 to 0.32, which interestingly enough is the same price that I sold it at, but now I'm up $42 on my underlying position. I'm up almost 6%. Well, you might be asking, if you're up 6%, why hasn't this contract increased in value? The reason is time decay or theta decay. When I sold this contract, there were 35 days left before it expired. Now there's only 14 days till expiration. What that means is it's not going to be worth nearly as much even if the price moves up. Now, if the price moves up a lot, of course that's going to be more expensive to buy back if you want to buy it back. But this is great because now I've got a $40 profit here. I'm basically break even here. And let's just fast forward one more week. We're going to go to May 3rd now and see what happens when we fast forward to May 3rd. And you can imagine if you do this on other stocks like, I don't know, Tesla or even the S&P 500, that's going to cause a lot of premium to be generated and you'll be able to protect from big swings to the downside. Again, the risk you're taking there is limiting your upside potential. Well, check this out. Now SoFi's back down to 7.22, 7.23, so I'm down $9. But look at this. The contract is now only worth $2. If I wanted to buy that back, that's basically 100% profit. There's still a week left on that contract. So in my mind, I'm thinking, it doesn't make any sense to let this contract continue for the next week because I'm only going to get $2 more if it expires worthless. So I'm just going to buy this back for $2. And look at that. Now I've bought that contract back for $2. I'm down $9 on my SoFi shares, but if you look at my total account, I started with $100,000. Now I've got $100,020 roughly, and that's because I sold that contract for $31. I bought it back for $2, so I made a net profit of $29 on that, minus this $9 I'm down. That gives me about a $20 profit. So I've just protected myself against that downside, and now I could go do that again, right? I could say, okay, let me push this 30 days out again, 35 days out. I want to do the same thing. I want to sell a call 8, or maybe I could push it further. Maybe I'll go call 9, or maybe I think, it's going to keep going down, so I want to protect myself and have a little bit closer of a strike. You can choose whatever strike you want to protect yourself against that downside. So I could sell here this call 8 for another $20, or if I want, I could push this out even further. I could say, hey, you know what, let's go almost 3 months out, or a little over 3 months out. I'm going to sell this call 8 or this call 9 for $40. Let's do that right there. So I'm going to sell that call 9. I sold that for $40. Looks like it filled at 41. And so now what happens if SoFi moves up? We're going to do the math on this one more time. So if SoFi moves up to $9, I have to sell my shares at $9 per share. And remember, I bought at 7.31. So that's a profit of 1.69 per share. We're going to times that by 100 shares. Plus, I received a profit of $29 on that first contract that I sold. I sold it for $31, bought it back for $2. And I've received a profit of $41 on this contract. So now my total profit, if I get exercised at $9 a share, is $239. That's on a $730 position. That's a pretty dang good profit over just a few months. And again, if SoFi continues to just kind of wobble here between $6.50 and $10 and bounces up and down, I'll probably have an opportunity to exit this contract for less than I bought it for. So maybe I could exit it at $20 or $10 and continue to take profits there while I wait for SoFi to break out to the upside. Now, another way that you could do this, so let's say that, let's just say that I wanted to wait, and now we're basically to where it's the market day for today, so we can't fast forward in time. But let's say what I wanted to do is I wanted to buy SoFi down here at $7 a share, and then wait till it moved up into the $9 a share, and then sell covered calls on it at like $10, $11. That's another way to do this. You don't have to be selling it right away. But this should give you a basic overview of how to sell covered calls and how you can use it to generate income every single month. So in this case, I've just simulated about 35 days worth of trading days, and I've generated $60 worth of income or $70 worth of income off of a $730 position. This is not indicative of how every trade's going to go. Sometimes you'll get exercised. Sometimes you'll get stuck in a trade where, for example, like let's pretend SoFi, instead of bouncing in this range here, right? This has been a pretty favorable range. What if SoFi broke back below and all of a sudden was trading at like $5 per share again? Well, in that case, you're not going to have enough premium to sell that far out of the money to where it'd be worth it. So you'd just be sitting on your shares waiting. So like, let's just pretend again, SoFi moved down to $5. So $8 would be $3 out of the money. Let's just again look. So we're at 7. Let's go to 10. So even though we're 3 months out, selling a call 10 would only generate 24 bucks, $8 a month. You know, maybe that's worth it. Maybe it's not. Who knows? But that's what would happen if SoFi drops down to 5 and you're trying to sell like a set call 7 or call 8, is you could get stuck in a position that way. So my general rule of thumb with selling covered calls, number one, only do it on stocks that you love the stock and you're okay sitting in the stock for a long time just in case it turns against you, meaning the price drops so far that you can't sell any premium to where it's worth it for the strike that you're selling at, right? So like let's say I bought at $7 per share and then I sold a call 8 for like 20 bucks. And then let's say the price drops down to like $3 per share, $4. $4 is the low right here. It's like $4 a share. Well, in that case, I don't want to sell a call 6 because if I do that, I'm going to be losing money if I get exercised. So then I just have to sit and wait till the price moves back up. That's why I say only do it on positions that you're like, you know what? I know that over time, or I feel confident that over time, Apple's going to continue to perform well. So I'm going to sell calls on my shares because even if it dips historically, it's always, you know, the dip's been bought back up as Apple's continued to improve as a company. Or maybe Apple's not a great example right now since it just surged on earnings. Let's look at like Palantir. So Palantir, and this isn't on demand, so it's not going to show, but on earnings, they just recently dropped from about $23 a share down to, I think it was $21 a share, right? So let's actually do this right now. I'm going to show you an example on Palantir. Let's say that I wanted to buy 100 shares of Palantir at $23.35 per share because earnings is coming up and I'm like, they're probably going to do all right on earnings, but if not, I want to protect myself against some downside risk. So I've just bought Palantir. I filled at 23.35, so this cost me $2,335. I'm going to move here to the trade tab, and I know their earnings are coming up in just a few days. So I'm just going to sell this 1 week out contract. I'm not even going to bother for a month. I'm going to sell, and this is I know this is gaming the system because I already know what happened. But I'm going to sell this 1 week out contract right here for 25, a call 25. I'm going to sell it for 98 bucks. So this is cool, right? What I've basically done is I've said, I'm going to cap my upside potential. If Palantir moves up from $23, 23.4 to 25, I'll just sell at $25 a share. And I'll make 160 bucks plus I just sold this for $99. So I'll make like 260 bucks on the trade, and it's a 1 week trade. That's a great, about 10% profit in a 7-day trade. Love it. But what I've also done is I've protected my downside because if Palantir drops, well, I've just got $100 in premium that I collected, so it could drop to 22.4 and I'd be break even. If it drops lower than that, I'll be losing money on the position, but let's just show you what happens, right? So I'm going to fast forward this now past Palantir's earnings. And boom, there's their earnings call came down. Now we're at 21.9. And let's wait for this to refresh over here so you can see what happens to the overall positions on Palantir. And what you'll notice, of course, is that as this, the SoFi, we'll actually get to look at the SoFi position too. This will be nice. Okay, there we go. So look at this. This Palantir position is worth $3, $4 now. I sold it for 99. So I've just protected myself against that downside. Now, true, my overall Palantir position, if you look here, I'm down $144. But because I sold this position, I'm actually only down overall about $40 on the position. Really nice place to be in. And check this out. SoFi's gone down to 7.1, so I'm down $20 here. But remember, I've already made $29 selling covered calls. And check it out, this other call that I sold is now only worth $35. So I've made $7 there, further protecting my downside. So protects against downside, gives me a way to generate monthly income. And again, if I see a stock where I know, hey, it's really just trading within a range here, maybe what I do is I buy at the bottom of the range, wait till it moves up, and then start selling calls. And then as it moves back down, I wait again, and then as it moves back up, I sell calls again. Great way to generate some extra income. Always do it with stocks that you feel like, hey, this is a good long-term stock to be in. And then also, don't get too attached to it, because sometimes you might get stuck when you sold a covered call. Let's say Palantir, instead of moving down to $21 a share, let's say they bumped back up to like $40 a share. Well, in that case, you know what? It kind of sucks, because I could have been up 100% on my position, but instead I have to sell at $25 a share, because that's the contract that I sold, is saying I'll sell my shares at 25 bucks a share. So you can't get too attached to your positions that way. You're going to have some that get called away, and that's okay, because you're in the game of generating income through premium of covered calls. Hey, thanks for watching, everybody. Have a great day, and if you haven't already, subscribe to the channel. We'll catch you next time.